Hey everyone, I'm Ella, a finance blogger with a decade of experience in global markets to 5 minutes a day to help you unpack hidden market trends, avoid investment traps, and seize real opportunities. Right now, the countdown is on for a critical event that will shape global asset trends. Next Wednesday at 2 p.m. ET, the Fed will announce its rate-cutting decision. Normally, during Fed meeting weeks around Capitol Hill in Washington, the mood is calm, reporters wait for results while chatting in cafes. Traders monitor their screens, and markets only see minor fluctuations. But this time, the air is thick with an indescribable tension. Over the past few days, step into any finance meeting, and you'll feel it. Analysts pour over dot plots to map policy paths. Fund managers rush to adjust strategies during conference calls. And even the most senior traders can't help but raise their voices to discuss positions. The market has already been ignited by vague policy hints, like puppets pulled by invisible strings. Even though Fed policymakers never explicitly said a September rate cut is certain, capital has already moved ahead of schedule. Just look at the current market. U.S. stocks have climbed steadily in recent days, with tech and AI stocks acting as if they're celebrating early. Treasury prices keep rising, pushing two-year yields to a cycle low. The U.S. dollar weakens, and gold picks up momentum. Even emerging markets like India, Saudi Arabia, and Brazil have seen volatile gains driven by hot money. All these signs tell us the meeting result hasn't been finalized, but capital has already flooded out like water from a breached dam. You must be wondering, Ella, the rate cut hasn't been officially announced yet. Why is capital in such a hurry to rush out? Has this global capital migration already started? Don't worry. Next, I'll break down the tripartite psychological game between the Fed, the White House, and Wall Street, and you'll realize this rally might be a trap. If you're worried about forgetting these key points, hit the save button now and subscribe to my channel. I'll update real-time meeting analysis later. Don't wait for a market reversal to look for guidance. But have you ever thought, when good news is priced in early, it can turn into bad news once it's official? Right now, the market is like a play where the audience is already standing and cheering, with flowers and confetti scattered on stage. But the actors haven't appeared, and the plot is still unknown. What if the loosening drama everyone expects doesn't happen? At that point, cheers would instantly turn to boos. The rally would collapse into a sell-off, and stocks, bonds, and currencies could reverse overnight. The ones left bearing the losses? Always the investors who followed blindly without seeing the truth. Why is the market so easy to manipulate with vague hints? There's only one root cause. The Fed's independence has long been fractured. The White House faces an election and needs a booming stock market as a campaign tool. Wall Street craves low interest rates to keep its leverage machine running. The media needs sensational stories to attract attention. With these three forces aligned, the Fed can only anesthetize the market with ambiguous statements. This is not scientific, monetary policy, but a blatant psychological game. And we average investors, we're the most expendable pawns in this game. Some of you might say, Ella, rate cuts are good for the market, right? Following the crowd to buy tech stocks can't go wrong. But history keeps proving this wrong. Rate cuts are never a universal bonus. They're a dividing line for capital migration. Some will be lifted onto the ship of wealth, while others will be swept away by the tide. Next, I'll walk you through 5 key rate-cutting moments, each with stories of people getting rich and others go in bankrupt. Want to know which traps to avoid this time? Hit the like button and let's dig deeper. Many people instinctively think rate cuts equals sure market gains, but history has already warned us. The 2001 dot-com bubble, the 2008 financial crisis, the 2013 taper tantrum, the 2019 trade war, the 2020 pandemic liquidity injection. Every time the Fed confirmed a rate cut, it triggered a global capital shift. After the 2001 dot-com bubble burst, the Fed was forced to cut rates. The market expected a tech stock rebound, but capital quickly shifted to real estate, pushing U.S. housing prices to all-time highs and eventually triggering the subprime mortgage crisis. After Lehman Brothers collapsed in 2008, the Fed cut rates to near zero and launched quantitative easing. Capital first fled to Treasuries and gold for safety, then poured into tech leaders and commodities to start a new bull market. In 2013, when the Fed merely hinted at tapering QE, capital immediately dumped emerging markets, crushing currencies like the Indian rupee and Indonesian rupiah. During the 2019 trade war, capital split into two streams. One rushed into tech stocks to profit from valuation gains from low rates, while the other clung to gold for safety. The 2020 pandemic liquidity injection was even more extreme. Zero interest rates plus unlimited QE pushed the Nasdaq, gold, and Bitcoin higher, but left most emerging markets abandoned by capital. Summarizing these 5 moments, we get an iron rule. After a rate cut is confirmed, capital will definitely change course. First, it abandons old bubbles. Second, it floods into safe haven assets. Third, it seeks winners of the new cycle. Fourth, it splits emerging markets. In short, rate cuts are just a switch. What truly determines your profits or losses is seeing which path capital finally takes. Now, the most critical question. Which path will capital take after next Wednesday's meeting? I've outlined 3 most likely scenarios, with clear upside, downside for each asset, and even timing for position adjustments. Want to know what to buy or sell for an extremely dovish, cautious, and ambiguous, or token rate cut scenario? Subscribe to my channel now. I'll break down specific targets later. And hitting follow ensures you get updates the second they're live. Next, let's break down each of the 3 capital migration paths after a confirmed rate cut. Simple enough for anyone to understand and act on. 1. Extremely dovish signals start of easing cycle if the Fed not only cuts rates, but also clearly signals an easing cycle. Global markets will explode instantly. Tech and AI chip sectors will lead the charge first, surging like dry tinder hitting gasoline. The US dollar will weaken immediately, with gold breaking key levels. Emerging market stocks will rally sharply as hot money flows in. But be wary, this rally is purely driven by liquidity, not economic fundamentals. If tech stocks miss earnings targets, their bubbles will burst faster than anything. After emerging markets' short-term gains, even a slight, the US dollar rebound will trigger capital outflows and a sell-off. Gold will follow the rally, but if economic indicators improve, profit-taking will trigger a reversal. Key strategy: grab short-term rebounds in tech leaders and gold, but set stop losses. Don't treat these as long-term positions. 2. Cautious and ambiguous split. Plot if the Fed cuts rates but speaks cautiously. With a vague future policy path, capital will split into 2 streams. Risk takers rush into tech leaders, like Apple and Microsoft, betting low rates will support high valuations. Safety seekers cling to gold, treasuries, and defensive consumer stocks, e.g. Coca-Cola, Procter & Gamble. The result is a barbell market where top tech stocks and safe haven assets rise together, while small cap stocks and highly leveraged companies are completely abandoned. Bonds will also split. Short-term yields fall, but credit spreads don't narrow, showing the market still has doubts. Key strategy: either go all in on top tech stocks or allocate to gold plus defensive sectors. Never stay in the middle ground. 3. If the Fed cuts rates slightly or hints no easing cycle start, the rally turns to a sell-off instantly. High-growth stocks are sold off first. The US dollar rebounds sharply, and capital floods back into the US. Core assets like a tide. Gold comes under pressure in the first phase, but if global risks erupt, it will be bought heavily by safe haven capital in the second phase. Emerging markets will suffer the most. Currency depreciation, capital outflows, and simultaneous stock bond sell-offs, possibly repeating the 1997 Asian financial crisis. Key strategy: in the short term, only hold you dollar cash, U.S. Treasuries, and stocks of domestic demand companies. Avoid other assets as much as possible. These three scenarios may seem complex, but their core is simple: capital will move. You just need to stand in the right spot in advance. Worried about mixing them up or adjusting positions too late? I've put together a Fed rate cut, 3 scenarios action guide, which lists what to buy, what to sell, and stop loss. Take profit levels for each scenario. Want a free copy? Go to the pinned link in the comments, reply rate cut, and you'll get it. But note, the guide is only valid before the meeting. Miss it, and you'll lose the chance to position in advance. Friends, in a few days, this meeting won't be just another news event. It will be a wealth redistribution battle. Some will stand at the end of capital's migration path in advance, while others will be swept away by the tide. The real key isn't the moment the decision is announced, but right now. If you pick the wrong side early, you'll have no time to adjust once the result is out. I need to remind you, this isn't an elite financial game disconnected from average people. Every confirmed rate cut reshuffles global wealth. In 2001, some got rich from real estate. In 2008, some hedged risks with gold. In 2020, some doubled their money with tech stocks. The difference lies in whether you saw capital's path in advance. Today, Ella has unpacked the Fed rate cut's psychological game tactics, historical traps, and 3 scenarios, all to help you avoid being wiped out and seize opportunities amid capital migration. If you find this useful, be sure to like plus save it for your next position adjustment. If you haven't subscribed yet, hit follow. My next video will teach you how to monitor real-time data on meeting days and adjust positions in 5 minutes, all practical, actionable tips. Leave a comment below. Which scenario do you think the Fed will choose this time? What assets are you most eager to protect right now? Tech stocks, gold, or treasuries? Let's discuss and avoid traps together. Finally, don't forget to follow Ella 5 minutes a day to understand global finance and make your investment. Lose less and earn more.